All right, good Thursday afternoon, investors, traders, our Finom Group YouTube audience. Welcome back to another weekly State of the Market. I hope you enjoyed last week's special edition of our State of the Market, where we discussed the possibility that the bottom of the bear market had been found. We're possibly setting the stage for a new bull market. It certainly looks that way. It certainly feels that way. We've had a tremendous rally off of the lows. There's still some work to be done. We'll talk a little bit about that as we progress through this week's State of the Market. But for right now, we'll take a kind of a measure of where we are. We've lost a significant portion of today's gains after the PPI data came out. We're now negative on the NASDAQ. S&P's only up 8 points. We were above our magic S&P 500 number. And again, we'll kind of talk about what that means. A refresher, those of you probably already know, but we'll get into that. So, we're definitely in an uptrend, but it really, at this point, it's going to come down to, we hit some key levels. You'll feel more confident about what to do during consolidation periods, because we should always be anticipating, after a pretty significant run, such as the one that we've had off the June lows, some type of some type of consolidation. Hopefully you were confident, already, when it came to buying those June lows and the June time period and the July time period as the market started to rally. But I know it's hard in the face of all those negative headlines, the financial media basically breathing down investors' neck with this negative and pessimistic narrative and that negative and pessimistic narrative, and the Fed's going to do this and quantitative tightening that, and nothing is good for the market. And in the face of all that, the market rallied. Got to learn how to tune out the noise, so to say. All right. I read this really good article this week from Michael Batnick of, I think it's Ritz-Hold Capital Management. So I extrapolated this piece from it. Again, this is from Michael Batnick. If we know that bad times are temporary and progress is undefeated, why is it so hard to stay invested when stocks fall? I buy the argument that there are some evolutionary things going on in our genetic makeup. Better to run first and ask questions later. But if we put that to the side for a moment, a modern answer is because we're surrounded by bad news all the time. Bad news are events, and good news is progress. Things just slowly get better and better. And incremental improvements, they just don't make the front pages. Gradual improvements basically go unnoticed. So I guess the crux of what Michael is trying to express is, we're just bombarded with bad news all the time. So it's just hard to hold. It's easy to sell. It's easy to give into the fear, the panacea of the moment. It's hard to hold on, even though we know 100% of the time stock market is going to make new highs. It's just a matter of when. Progress is undefeated, as Michael says. The reasons to sell, this is a map of the S&P 500, going all the way back to 2009. These are the headlines that litters the trend. But the market makes new highs anyway. It's just a matter of when. There's always reasons to sell. You got to resist. He goes on to say, but if you want to be a successful investor and a happier person, you need to break free from the shackles of pessimism. There's no such thing as a successful pessimist when it comes to investing. I've never met one. If you think you're going to be that one, that unicorn, you're kidding yourself. You are kidding yourself. No successful investors are pessimists. The two are just opposing dynamics. Headlines, right? This is a bear market rally. That's all we've heard since July. It is all we heard. July delivered a 10% plus return in the S&P 500 and NASDAQ. And all we heard was it's a bear market rally. That is always going to be the headline. Remember the whole, well, I'll just move to cash, how I've been professing that is a terrible idea, right? Because then you got to make two really good, timely decisions, when to get out and when to get back in. As I've often said, do you think the headlines are going to get any better? Think about the current phase. Has the headlines changed? Have they been any more optimistic during this robust 14% rally off of the July lows for the S&P 500, 20% plus rally off of the June lows for the NASDAQ 100? All we've been littered with is negative headlines. They don't change. How do you think you're going to feel confident getting back in the market with negative headlines, which kicked you out of the market in the first place? And everybody, bear market rally, bear market, they always say that. Every time we have a bear market and we start to rally, or a severe correction and we start to rally, that's the headline. Nobody believes it's a new bull market or a reversion, a return of the uptrend. Nobody believes that until, well, it's in the rearview mirror and they miss the entire move. 2011, right? Remember, we were rising into the end of 2011 into 2012, bear market rally. 2011 market report into a bear territory, late day rally. Looks and smells like a bear market rally. Same thing, November of 2011. Is this a bear market rally? 2011. Here's from Doug Cass. Remember 2016? We put the bottom in. It was a double bottom from 2015 into the first quarter of 2016, and then we started to rally. You've been warned. This is a bear market rally, says Doug Cass, right? Very popular and widely respected Doug Cass. Was that a bear market rally? No, we just kept going higher until the end of the year. Everybody says the same thing every time. It sounds smart. It sounds cautious. Therefore, I'm dealing with money, so it's smart to sound cautious. Missing out on tremendous rallies. 2019, right? We had a significant bounce off of the Christmas Eve massacre of 2018 and that fourth quarter of 2018 technical bear market. And then we just kept rallying through January of the new year into February of the new year. People were saying, no, we've got to retest the December 2018 lows. Dow recovery, nothing more than a bear market rally. That was February 25th, 2019. What happened, folks? 2019 delivered a 31% total return for the S&P 500. They say the same thing every single time. But we have mile markers that can help us to distinguish whether or not it is just a bear market rally, a reversion to the uptrend, or a new bull market. This is great. I hope everybody gives this a little bit of time. You've got to listen to this recent interview with Patrick O'Shaughnessy. He's talking to Will Thorndike, asking him some questions about, why do you think you're always bearish? Will Thorndike, he's another, very famous investor. And he says, why do you think you're always bearish? What is it that for a long time has made you bearish? And Will responds, it's really hard to make the bullish case, at least for me. They're always daunting. Trying to make the bullish argument is always a daunting task. In the background, there's the warming of the climate and there's secular trends that are inarguable. I really just tune it out and don't let it affect my investor behavior. I mean, I'm as busy now as I've ever been, looking at new investments. And if I did, looking back in hindsight, thank goodness I haven't let it influence my investing behavior. He knows he's a perma bear. He knows the headlines are scary and they're it's going to drive a bunch of people out of the market. But if you fall prey to that, you become your own worst enemy. Will Thorndike, he knows he's a perma bear. He knows he's too cautious, but he still plugs away. Here's kind of a, this is a really good visual aid. But here's the Twitter account that I found it. It never seems like a good time to buy. Market is too high. Had a really nice rally. Market's too high. Now market's going lower. I don't know. Maybe this was a fake rally, right? A bear market rally. And it takes off again. Now market's really too high. And then it checks back, waiting until things settle. We'll always make excuses. This is why just, following price and hoping, that you just get in at the right time. It's better to work off a game plan. When you have a game plan, you're taking the emotions out of it. I mean, most investors, I would really ask you to question yourself from June to today. What was your activity? Did the headlines scare you? Did CNBC Fast Money Crew scare you on a daily basis? The folks that come on Bloomberg, or what is it, Market Reversals, with Guy Adami and Dan Nathan with their negative commentary every single episode. Do those guys scare you out of executing your game plan? Be honest with yourself. Now's the time to course correct. We're 7 months through the year. We got 5 more months worth of trading to go. We got a lot ahead of us. Why do you want to stay in the market? Look, this was so far a pretty terrible year. This rally's great. Don't get me wrong. It helps to alleviate some of the pain that a lot of investors felt during the beginning of the year. But look, you have to think long term. You have to think long term. History shows us that the easiest way to boost your chances of success is to simply hold longer. If you hold for a day, you got a 50-50 shot of making a profit. 2 months jumps up to 60%. A year jumps up to 68%. 5 years, 80% probability of turning a profit. This is speaking to the indexes, of course. 20 years, you've never lost money. 30 years, you've never lost money if you just own the index ETFs. Expand your time horizons. This is a bad year. It is what it is. Expand your time horizons. Stay invested. All right, just kind of a revisiting, a few weeks back, a big weekly gain of greater than 6%. May 20th to May 27th, we had a greater than 6% gain. We got to be above 41.58 based on this study 3 months later. 3 months later, because on the 27th, we were at 41.58, if you don't recall. We're above that, I think. Yeah, we're above that right now, but if this is going to hold true, 73% positivity rate, we should be above 41.58 3 months after this signal here. Some review. Just the other day, I think it was Monday, the NYSE cumulative tick hit a new all-time high. Again, this looks at when the tick makes new all-time highs, 2021, 2020, going all the way back to 2008, when the tick makes a new all-time high. By the way, the tick index compares the number of stocks that are rising to the number of stocks that are falling. That's all. It just subtracts the two. We hit an all-time high as of Monday. So looking out, let's go 2 months out, 3 months out, 3 months out. We've only been down 3 times since 2008. One was first quarter of 2018, and one was 2008. We know that was why that happened, and one was in 2012. This is another piece of quantitative data looking at just how strong, some of these daily advances have been, and how we've accumulated more stocks rising than stocks falling. So good study. I mean, high percent probability, 3 months later, a lot of green, only 3 times red. And that is a lot it's a big sample size, right? Again, that's the NYSE tick hitting new all-time highs. Here's another one. S&P 500 performance when percentage of issues are overbought, greater than 71. Greater than 71. When the percent of stocks with an overbought or greater than 80%, stochastic oscillator surges to this green line is that 71%. And we got there yesterday, by the way. There is no looking back for the S&P 500 in the forward 6 to 12 months. As shown in the chart above from Sentiment Trader, forward returns were all positive. Here's the different times that it hit those levels. 6 and 12 months later, it's been higher every single time. We just did it the other day. We talked about the NYSE summation index making a cyclical low, and every time it cycles from negative 750, where we have the line here, back up to the unchanged level, it's validated a new bull market. We've also talked about it getting back above 500. NYSE summation index is on the verge of crossing 500 after a market correction of greater than 10%. Since 2003, it's happened 1, 2, 3, 4, 5, 6, 7, 8 different times, now being the 9th, because we're above 600 on the summation index as of today, above 600. The only times that the signal failed were these back during the top dot-com period. .com/recession /9/11 period. But every other time this has occurred, the blue lines here, the market was positive a year later. So it hasn't been red except for those 3 signals back there. Here's another one from Ari Wald of Oppenheimer. This basically tells us, everybody said, well, we need capitulation. The VIX hasn't hit 40. I don't know why everybody's so in love with the VIX in that number. It really has no viability so far as a market signal. The reality is, if you take all the corrections and all the bear markets going back to 1990, the average VIX peak for all corrections, all bear markets, put them all together, the average peak in the VIX is 37. So I don't know where this 40 number comes from, but people love it. It just gets, it's the squeaky wheel, it makes noise. So, but Ari Wald of Oppenheimer says we've already seen capitulation. Not only did, it's kind of like the baby got thrown out with the bathwater back in June, but low volatility, the low volatility ETF was also 10%. It dropped more than 10%. He says there's full capitulation in June. Defensives and low volatility ETF fell 10% below its 200-day moving average. I mean, what is there to buy if you're not even buying low volatility ETF? And that's below its 200-day moving average by more than 10%. It's a sign of capitulation, folks. Since 1980, such levels identified capitulation, likely to see some base building in Q3 with an upturn into Q4, says Ari Wald of Oppenheimer. All right, so earlier on, we talked about the magic number, S&P 500. Historically, and a lot of you have already seen this, after a 50% retracement from the low, there's never been a retest of that low. And the going back to 1972. So the magic number to hit that 50% retracement off of the low, the magic number is 4231, which we more than achieved today. Asterisk or caveat. It has to be on a closing basis. 4231 is that 50% retracement number. It has to be on a closing basis. So we've got to do 4231 or better. Going back to 1972, if you retraced 50% of the down move, you've never retested the low, you are in a new bull market. 4231 is that level, folks, 100% of the time. Not all recessions are bad for stocks because they're still promoting this idea that we're in a recession. No, it's the government that changed the definition. Stop it. Stop it. The reality, no, not all recessions are going to deliver negative returns through the recession. And that's what this chart basically, it takes every recession since 1945. The average return is actually 1.1%. The median is 5.4%. Well, how can that be? Remember, the market tends to bottom before the recession actually ends. Going back to our chart that we looked at, this from Ned Davis Research, the S&P tends to bottom 4 months before the actual recession end date. 4 months, the recession end date. It also has already usually bounced 10% or greater. Again, that's why, do you expect, I mean, we're still in a recession here, technically. You know, it ends here. The market has already rebounded. There's no good news. There's no good news out there. The headlines are still bad. Stay invested because you're likely going to miss this move. We just bounced 14% off the lows and 20% off the lows in the NASDAQ 100. We're not even in a recession. All right, a lot of you have seen this chart too, but I want to take it a step further. This is the CAPE ratio for the S&P 500, right? We're looking at PE multiples, basically. I've always contended that multiples expand over time. This chart validates that. And you say, well, Seth, how can you say that when, you know, this was the peak and we haven't gotten back there since 2000? Again, we're in the channel. I mean, I can see, why aren't we focused on this? Why aren't we focused on that? You still have an upward rising channel. PEs expand over time. Why do they expand over time? Right? A lot of folks would say this is a chart crime. You shouldn't be. I've seen everything charted, folks. Everything in the market, everything in the economy being charted, correlated. I've seen it all. So don't tell me this is a chart crime. Like, I get it, but it does demonstrate a fact, which is PE multiples expand over time. But we want to know why that is. And the reason that is, and this is explained perfectly by DataTrack. The S&P 500 is currently earning about $225 to $228 a share on an annualized basis, based on what we've already heard out of the Q2 earnings season. A relatively shallow recession would cut that number by about 10%, so maybe $205 per share. That's still better than the S&P 500's pre-pandemic earnings of $162 to $163 a share in 2018 to 2019, which were the prior cycle's peak. What we see in this chart here is that U.S. corporate profits as a percent of nominal GDP has gone higher over time. Back in the 1980s, U.S. corporate profits as a percent of GDP was only in the 5% range. In the 1990s, 5.7 to 6% range. In the 2000s, it jumped to 7.4 to 7.6% range. In the 2010s, we got up to 10%. Corporate profits as a percent of nominal GDP, upwards of 10%. Since 2020, we're at 11+%. What does this tell us? This tells us that corporate profits are that much more robust. The companies are more efficient. They're delivering more profitability than they have over the past 40+ years. So you should expect multiples to expand. All right, here's how DataTrack puts it more eloquently. U.S. corporate profits as a percent of GDP have been increasing every decade over the last 40+ years. They started in the 5% range in the 80s, grew to 7% in the 2000s, then expanded to 10% in the 2010s. They are 10 to 11% now. Simply put, U.S. companies are remarkable profit machines, and there's nothing in this analysis to suggest that this will fundamentally change anytime soon. S&P 500 companies are remarkable profit machines. Multiples don't expand because there has to be a reason for it. And this tells us what that reason is. And this validates what we see in multiple expansion over time. Companies become more profitable and just continue to churn out those profits. All right. We got the inflation readings this week. CPI, thankfully, good news, better than expected news. I'm not going to entertain the, well, it's only this and it's only that. It's been bad for a while. Let's take the good. Let's take the good, because it was a good and better than anticipated number. And we don't know what the next month's reading is going to be, but it does validate everything that we have been suggesting, which is that the peak in the inflation cycle happened in June. S&P 500 anticipates the peak in inflation starts to run up. Here's the actual inflation peak. S&P 500 performs quite well after inflation peaks. Here's another way of looking at it with actual numbers. These were past 14 cyclical peaks in inflation, and the S&P 500 one-year forward returns. Average of all of these, cyclical peaks in inflation, the average 12-month return is 13%. Out of these 14 occurrences, only 3 were negative. This one in 2008, we know that was not about inflation. This one in 2000, again, not about inflation. And this one right here in 1957. So again, you can look at it this way: S&P 500 performance after peak inflation, or you can put some numbers behind it. Figure to give you the best of both worlds. Investors can often get distracted by the hyperbole of the financial media. The reality is the core CPI. That's what this chart is. This is the core CPI. It's been down 1, 2, 3, 4 months in a row, and it now rests at 5.9% core CPI. But you wouldn't guess this from the financial media's hyperbole. One sticky component that we hope sees some disinflationary forces is apartment rent, or as it's incorporated into the CPI as the category of owner's equivalent rent. And you have to take this into its appropriate context. While rents are still rising, remember, CPI does not measure up or down. It measures the rate of change. If we look at owner's equivalent rent or rental prices from July of 2021 to July of 2022, we can see, are prices higher? Yes, they've risen by, on average, 0.08%. But look at this from 2021. The rate of change has been much, much softer in owner's equivalent rent. Still rising, but at a softer pace. Again, financial media. This is something I wanted to point out. Last week, I saw this tweet from Liz Ann Saunders, well respected, from Charles Schwab. She's an equity strategist / analyst. And she says the savings rate continues to evaporate, now at the lowest since August of 2009. Now, I've always got these numbers running through my head. And one that we have discussed quite frequently here on State of the Market is the fact that the household checking and savings are at their highest average balance in basically history, at least 40 years. So why would they're getting their paychecks? They've got a high, savings account balance as it is. Why would their savings rate, remember, that's a rate of change. It's not how much they're saving, it's the rate of change on a monthly basis. So why would the savings rate go higher? If they already have excess savings, historically speaking. And that's why I retweeted it saying the highest average savings checking balance in history at $1,700 per Bank of America, nearly double the pre-pandemic average. You seriously wonder why savings rate is low? Again, why would the savings rate be high? I'd be nervous if the savings rate was high, given how much savings, the households have already accrued. I would be worried about a high savings rate. Clearly, there is excess for the average household, so savings rate would be expected to remain lower than usual. I mean, that's my argument. I was happy to see that JP Morgan's team, led by, I don't know how to pronounce his name, I know his last name is Mislov, but he says consumer is likely to be cushioned by excess savings and strong labor market. Same chart, the savings rate, same chart, right? They're using, and their commentary is the consumer has been hit by the purchasing power squeeze, but is cushioned by the excess savings accumulated during the COVID period. This will ensure that the savings rate moves lower, but without much demand retrenchment in our view. Basically saying exactly what I thought. It's nice to hear that other, people are of the same mindset. All right, the dollar, we've talked about the dollar, right? We looked at this chart back on July 14th when the dollar was soaring. It's come way in. It's come way in now, but, this is just kind of revisiting the fact that, you go parabolic in anything and it's going to correct. And usually it happens around when the Fed is hiking rates. The dollar typically peaks 3 to 6 months after the first rate hike. It's basically where we are. The first rate hike was in March, so 6 months later, the peak should have been in the rearview mirror. 3-month returns on the dollar index, the 6-month return, I mean, they're all negative. And we have been lower here recently on the dollar. We were upwards of 108.50. Now we're at 105.05 on the dollar index. We had been flirting with the 104 handle here this week, on the last couple of days, including today. And usually that's the testing, you kind of dip your toe in the water of a new level to see how it feels, but it's usually setting the stage for, cementing yourself in that level and beyond. How do I know we're not in a recession? Well, I mean, don't we usually talk about earnings are negative in a recession? Year over year earnings go down in a recession? Like, that's not happening here, right? That hasn't happened. Earnings have not contracted. Each of the past 11 recessions had negative earnings on a year over year basis. We're still anticipating, and the forecast is still for around 8% year over year earnings growth, with the guidance that's already been delivered here through the second quarter earnings season. We still have one more real full week of earnings, and that's going to be retail. Retail usually wraps up the earnings season. All right, folks. Well, I hope you enjoyed it. I hope you kept your wits about you through this whole bear market. And again, the magic number, 42.31. That's the 50% retracement off the low. Every time since 1972, we've achieved that feat of bullish strength. The market has never retested the low. That was the bottom, and it was a new bull market. Thank you for joining me here again on our weekly State of the Market. Trade safely, everybody.